For attending the second session. Our focus on the second session is to understand the interlinkages that might exist in international trade activity, and in particular the financial flows and the trade flows, and to try to set the stage in our next discussion as to what are the interdependencies in the financial sector when it comes to financial services, when it comes to trade. I'd like to, you have seen the program, and we have three distinguished panelists here. I would like to start with Catherine Mann, who served as the former chief economist at OECD, and right now serves as a chief economist in Citi Group. Catherine has a distinguished career, not only in academia, in research, and in the Fed, and at the same time she served on the board of GIC, and we're very thankful for her participation today. She's going to be the first. Then we have Bill Stone. His CV is included in the program. Well known here in the Philadelphia area for many years as being the chief strategist and investment officer at PNC, but we lost him to Texas, and he moved there to be a chief investment officer of a big asset manager. And then we are very pleased to have with us a great economist coming from Vanguard, Andrew Patterson, who's going to talk to us about economic conditions in economic issues on the world trade. So our approach will be 15 minutes presentations, 15-20 minutes, and then after that, please hold your questions. We will have a Q&A session, and we'll start with Catherine.
Well, thanks very much, George, for the introduction. And of course, you couldn't have chosen a better day for this topic. I'm surprised people are not on their, on their phones seeing what's happening to the markets, because talk about the interlinkages between trade and finance. I mean, we're seeing it play out as we sit here. So I'm going to go through a couple of issues as a backdrop to this topic. So this is based on our global economic prospects. We do this once a month, and always looking for something new to talk about. And so I'm going to talk about trade and financial and investment interlinkages. I'm going to put it in the context of the current conjuncture with regard to our prospects for global growth. I'm going to talk a little bit about the trade issues. And then, depending on the time, I might talk about some policy scenarios that we've developed in the context of the trade tensions. So here we are with our current conjuncture. We have seen growth stabilize. You can see it most significantly in the pink part of the graph on the right. Those are our forecast revisions. And you can see the stabilization of the forecast for 2019 going from, we had done successive downgrades, and then last month we recovered just a tad. Now we're only recovering though to kind of our long run growth rate of about 3% on the global level. That's in the left hand panel. The dotted lines are long-term averages. So, we're stabilizing, but I think we still have a tremendous amount of risk in terms of our prospects going forward. It's a very fragile stabilization for a number of reasons. There's, first reason is there's fragility because there's a divergence between the growth rates for the advanced economies and the emerging markets. You can see that by the red in the left-hand panel. That's the divergence between the two growth rates. So we're a long way away from this synchronized global upturn that we had at the beginning of 2018. But on the other hand, we are also not in the, the globalized synchronized slowdown, which was in 2015. which you can see there, where everybody was slowing down. So it's stable, but it's fragile, and if we want to see more resumption of global growth, we need to have recovery, particularly of the advanced economies. And within the advanced economies, you can see that the part of the world that has not really been an important contributor to our projection going forward for global growth is the euro area. That's the red set of bars in the middle of the right-hand chart. So euro area, which is very strongly related to trade, has not been, and we do not see it being, an important contributor to global growth going forward. The resolution of the trade uncertainty that we've been talking about, and we don't know whether we're going to see it or not, is an important ingredient for Europe, even though it is not the one, that part of the world that's in the crosshairs right now. Of course, the crosshairs is China, but to the extent that China's rebound is affected by the resolution of a trade uncertainty, that percolates through the global economy, not just on East Asia, which most people kind of would get that, but indeed the percolation of trade tensions into Europe, Germany being the most obvious candidate, but within Europe more broadly, that is key. The resolution of trade tensions between the US and China is important for resolving the growth slowdown, sluggishness in the euro area. So another piece of the conjuncture that is representative of this fragility of global growth is that there is a tension between the domestic economy, between where consumers are and where business is. Now we look at sort of three pillars for our economic outlook and our prospects. The three pillars are domestic resilience, based on very strong labor markets, improving wage prospects. That's the good pillar. The second pillar is trade headwinds, which of course is a very significant concern, and it is manifested in this slowdown in business sentiment and this slowdown in business investment that President Harker mentioned in his speech. And you can see that tension between businesses and consumers by looking at these two set of charts. On the retail sales side, you can look at where we are in terms of the advanced economies. That's the light blue, which, yes, has turned down a bit, but is well above the advanced economies' growth rate on average, which is the blue line. It takes a nice long average, 1990 to 2008. So retail sales, even though it has softened somewhat, has actually remained quite robust in the advanced economies. And of course that makes sense when we think about the strength of the labor markets in the advanced economies. The US at, almost, not quite unprecedented lows, but certainly in the experience of probably, I don't know, 3/4 of the people in this room weren't even born when the unemployment rate was last at its current level in the US. And in Europe as well, strengthening labor markets and strengthening wages, supportive of those, that retail sales, so strong consumers. And the emerging markets, if you abstract from China, you have emerging markets right at their long-term average. That's the green. Again, having come down from this where they were very strong at the beginning of the synchronized global upturn period, but nevertheless are still above their long-term average. And the global economy as a whole, dark blue, well above its long-term average. So the consumer side of domestic resilience is really quite good. On the other hand, we've got the business side, and that the industrial production not being nearly as good news. And of course the reason why is because industrial production, manufacturing, relatively more exposed to global trade tensions, and so you have a deterioration in industrial production growth rates, not only the delta being negative, but also the level relative to historical experience. Again, these long-term averages not looking very good. So the deltas and the levels being less attractive for industrial production because it is more exposed to the international trade tensions. So this is a picture of where we are on these trade tensions. Looking at the at the left-hand panel, you can really see in the high-frequency data just how dramatic the decline in the growth rate of global trade is, and has been over the course of this year. And it deteriorates very dramatically, the red line being the pretty obvious, but also in the advanced economies as well. The deterioration associated with the increasing trade tensions promulgated by the U.S. administration. But it's not just the trade headwinds of the most recent time period that I think we need to be concerned about. Because these trade tensions are against a backdrop of a structural slowdown in trade. And we can measure this in a number of different ways. And in fact, the first presentation for the day showed how much trade integration had slowed. The presenter had a chart which showed exports plus imports as a share of global GDP, and it was actually flat from about 2007, maybe associated with the financial crisis, but actually preceded it by a little bit, a flattening of global integration. Now the chart you see here on the right-hand side is an elasticity. So it's the rate of growth of trade relative to the rate of growth of GDP, and so it's an implied elasticity. And again, you can see in a comparison to the long-term average, which is there in light blue, just how much trade as a elasticity with respect to GDP has deteriorated in the post-financial crisis period, but even was starting to be soft relative to that. Now, of course, we care about that because trade is the source of additional markets, trade is the source of a variety of products, trade is the source of lower costs, trade is the source of lower prices, trade is a foundation for productivity growth through technology transfer and through market discipline. So we are bothered not just by the immediate and dramatic slowdown in trade that we see right now, but we are also very concerned about the underpinnings of a structural slowdown against which the trade war is being undertaken. So how does this all feed back into where we are with regard to business investment? The pattern of business investment you can see on the left-hand panel, that's just a replication of what we've already been talking about. But what I want to draw your attention to is the panel on the right-hand side. Now what we're doing in this panel is we're looking at changes in financial conditions and changes in trade uncertainty. So these are both measures of uncertainty. So we can show that tightening of financial conditions, of course, was relevant in 2018 as financial conditions were tightening. That's the kind of like the light blue bar. But more important for undermining business investment was the uncertainty with regard to trade. And so this is a measure of trade uncertainty in the G4, and it deteriorated significantly last year as the trade war was really starting to heat up. Now it's not so bad by our metric in Q1. This is when the trade negotiations were underway and it looked like things were going to work out. But it's still, all of this still represents a drag on business investment. And again, it is a particular note that the uncertainty with regard to trade dominates financial market uncertainty in undermining business investment. It's part of the extent to which demand matters more for business investment than does financial conditions. back when we were doing Macro 101, and we talked about accelerator investment functions, we had in there, you know, financial conditions or the cost of capital, and we had demand. And over the years, what has become very clear and is, you know, manifested in this diagram is that uncertainty with regard to demand conditions dominates uncertainty with regard to financial conditions or the cost of capital. And I think we need to be remembering that as we go forward between the links between trade and finance and business investment, which was the title of the session. So how, looking now explicitly at financial markets, what do they think about all of this domestic resilience versus external tensions? So the top panel on the left-hand side, this is a bunch of different measures of stock market or equity market performances. And now, if I hadn't had to send this through compliance last week, I could have put today's stock market index on there, and it would look different. It would look different. We would have seen a lot of downturns there to just give you an indication of just how important you know, the trade tensions are for equity market performance. But it's also true that the equity markets differentiate between firms that are externally oriented and firms that are domestically oriented. So the bottom panel on the left-hand side in the dark blue line shows the ratio of stock market performance of the top 100, or within the S&P, the top 100 by share of revenues in the external marketplace abroad, multinationals abroad, relative to the stock market performance of the top 100 S&P revenues earned within North America. So those are quote domestic. And you can see how the synchronized global upturn between 16 and the beginning of 18, that meant that the externally oriented firms with higher revenue externally were outperforming their domestic counterparts. You can see where that trade tension really started to hammer the firms, the externally market-oriented relative to the domestic-oriented just in the 2018 period. And you can also see that the financial markets were pricing in a successful trade deal, a successful return to outperformance or relatively better performance for the international top 100 international stocks. My view at the time, and still is, that their pricing in a deal is probably not going to be as good as they think. Now, another way of measuring the relative better performance of the domestically oriented firms are to look at services, because of course services are mostly domestically oriented, and so the services providing firms in the Russell are outperforming the non-services providing firms in the Russell, and that's in the table or the panel on the right-hand side. So let me turn now to what a couple of scenarios for trade deals are. We've done a couple of different scenarios for trade deals. One is 25% tariffs on all Chinese products. We did this last November, but I guess we might be turning out to be right. So this is looking at 6,000 different products using the Trade and Value Added database at the OECD and evaluating two different dimensions of vulnerability and diversion. So part of the reason for doing this is to have this much detail is to evaluate to what extent financial markets are properly differentiating the exposure of emerging markets to this trade tension that we have between the US and China. So the top panel looks at just supply chain vulnerability. So it sort of takes the attitude of, you know, like I'm a US buyer of widgets. And I currently buy those widgets from China, and there's a supply chain for the widgets. And if I decide I'm not going to buy the widgets from China anymore because they cost 25% more, who in that supply chain is most vulnerable to me not buying widgets from China? And so we find that Taiwan and Singapore and Korea are number 1, 2, 3 in terms of supply chain vulnerability, and then Vietnam, Malaysia, and Thailand are 3, 4, and 5. Now, if you made your investment decisions on emerging markets totally on that foundation, you would not be right. because I am still going to need to buy those widgets for my supply chain, so I'm going to go look someplace else to buy widgets. Not from China, so who am I going to buy them from? That's the bottom panel, trade diversion. And you'll see who I'm going to divert to is Mexico and Canada. Those are the first two bars. Not surprisingly, if it's auto parts, I'm going to go to Mexico and Canada. If it's furniture, I'm going to go to Mexico. So that's the first winners, quote, quote, in the trade war. And then the second, the third, fourth, and fifth are Vietnam, Malaysia, and Thailand again. They become my source of widgets if I cannot get them from China, or if they're going to cost me 25% more. So if I did not take that into account in making my investment decision, I would be taking my investments out of Vietnam, Malaysia, and Thailand when I should be putting my investments in there, financial investments. Korea, on the other hand, as you can see, Korea is number 3 in terms of losing, being most vulnerable, and it is not an alternative source of supply. So it's not surprising that we see Korea being particularly vulnerable in terms of exposure. So that's one type of example of how a trade war with China might play out. And as I say, there's more differentiation that we should pay attention to. Now, of course, by looking at the top numbers, which you might or not going to be able to read there, nobody wins here. There are net losses at the end of the day. Now, an alternative modeling of this trade war is the so-called shopping list. That the shopping list is that the identification is the U.S. is going to give China a shopping list that is going to add up to $200 billion, or maybe not, maybe more than that, $200 billion worth of trade, and China is going to pick items off the shopping list. It's going to buy some more cars, and it's going to buy some more airplanes, and it's going to buy soybeans, and it's going to buy chips. They would like to buy chips, but we're not going to sell them chips because that's a national security issue. So we can evaluate the extent to which other suppliers to the Chinese marketplace of the items on the shopping list, China's not going to buy from them anymore because they're going to be buying more from the U.S. Be expensive, yeah, but we're going to fill the shopping list. And so we can go down the list of which countries are most likely to be exposed if we think that this deal is going to be a shopping list deal. And Singapore is number 2 there again. There are a lot of resource-providing economies that are going to be worse off. A lot of those in terms of their percent of GDP. These are markets that are not important for China, but the Chinese market is very important for these economies. And so they are very exposed to the shopping list deal. So I'm going to turn now to just say a couple more words about financial turbulence, and just focus on one issue. So one of the things that the financial markets might be paying attention to is what kind of risk there might be in the financial system. And volatility today, I think, was probably much higher. But again, I had to do this last week. And what you can see here is that basically in financial markets, they're not taking into account volatility. They're not taking into financial risk on risky credits. The share of high-risk bonds is still 50% of issuance, approximately, as compared to only about 25% prior to the financial crisis. And yet the spreads are exactly what they were prior to the financial crisis. So higher share of risky assets, same spread. You're not going to get, as soon as any of these markets turn, those assets will not be selling at par. So let me finish by talking about some policy issues, because I'm running long. So this is our trade policy only scenarios, where we either escalate or we roll back in terms of trade. The escalation is beyond the US-China trade escalation. It involves retaliation, and then the US focuses on Germany and autos, and then there's retaliation from that. So it's a pretty negative scenario. You can see the downside risk The US is not the one who is most hurt. That's a center 3 set of bars. The baseline is in the center, the light blue. So the loses a 0.5 percentage point of growth for the US. But look at what happens to the Eurozone. The Eurozone essentially is going to be flirting with recession. So is Japan. Advanced economies in general, relatively slow growth. And the swing for the emerging markets in this trade upside, trade downside scenario is about a percentage and a half, more like a percentage of 170 basis points. So in terms of summary, we've got domestic resilience, and it's offset the headwinds, but it's not clear how long that continues to be true because of business investment pausing on account of uncertainty. The US-China trade deal, we still think there's going to be one in the second half, but the uncertainty will remain, and as I say, I think there's going to be a lot of buyer's remorse when we really see what's inside that deal. There's a lot of heterogeneity in how the financial markets are responding to this fragility between what is happening on the domestic side versus the external side. There's generating a lot of turbulence, and so policies are important ingredients to offsetting the trade headwinds. Thank you.
Bill?
Thank you. Oh, that's why it didn't. No, it was just, I didn't see the, there we go, sorry. All right, well, thanks for having me today. I am going to focus, since my role is really primarily investments, on, I guess I'll say, the investment implications of trade. I guess, again, I have to thank President Trump for his tweets over the weekend, because it certainly made things a little bit easier to show it. Last I looked, well, Shanghai's closed, but the Chinese market was down about 5.6%. Last I looked, the S&P was down about 1%. So I think it is interesting because some of the things, at least I'll show, it looks like when you talk about the China-US trade, I guess, argument here, tariffs tend to hurt the Chinese more. So at least it seems to be reflected in the markets. I'll show you a little bit more about that. I wanted to look at it a little bit through the lens of the fourth quarter. So I think it's hard to disaggregate exactly the impact of the trade. There was so much going on in the fourth quarter. I kind of roll it all up into the global economic slowdown, but then kind of take it apart a little bit best I can into some of the other pieces going on, and then roll forward here to the first quarter through the end of last month as we continue to go. So hopefully that'll shed at least some light on things. I think I kind of look through the lens of, I think the markets are certainly aware that tariffs are suboptimal policy, so and they do raise some sort of risk. It's hard to exactly put some probabilities on things, figure it all out, but hopefully through some of the things I'll show, you can tell that it does seem to be, certainly at least in some security pricing, we saw it priced in terms of relative performance. First on the big markets, and I know we showed some of, Catherine I think showed some of these similar things. This is just really, I cut it a million different ways into different parts of the world, but the yellow line at the top is the consensus estimates for the global economy. All I'll just point out is you really saw them start to decline in the fourth quarter. This is consensus estimates, for 2019 GDP. You really saw them start to decline in the fourth quarter, really across the board. I didn't show the PMI data. I like to use that to kind of look at what the momentum, kind of economic momentum going on is. Really, the Eurozone was slowing all year in 2018. China peaked in May of 2018. The U.S., which was really kind of, I think, the marginal change, and obviously such a big economy, that's the one that peaked in the third quarter. So I think that's why you really saw more disruption show up in the fourth quarter. So let me look a little bit again, another kind of, I'll say, you know, signal from the financial markets as to some of these fears about the, I'll say the U.S. economy, but I think they're connected, U.S. and global economy. This is just the yield curve, so you look at the 10-year minus the 2-year. We saw it narrow in really, I guess, the relatively recent peak at the beginning of October, and then bottomed out at about 11 basis points in mid-December. I know the one that got publicized a lot because it did finally invert it in early in 2019. I honestly don't really watch it that much, but I showed it because everyone, you know, talked about it because it was kind of the first big inversion. Was the 10-year minus the 3-month. This one, I guess, it's good to show because, you know, it kind of gets there, which that spread was at 100 and some basis points at the beginning of October and got down to about 15 basis points at the beginning of January of 2019. So I think at least for me making up data to show, it's perfect. So I like that. So I do think it does show you two things. One thing is some fears about the slowing economy and also fear about a Fed error, and I'm glad Patrick Harker left because now I can talk about the fear in the markets of a Fed error. Oh, I'm sorry. So please, you know, close your ears. I'll be nice though. I'm not gonna, you know, throw you under the bus. And now I'm gonna say nice things about the Chicago Fed. How about that? So sorry, I didn't have a Philly Fed thing, but I think one of the things that I like to look at is financial conditions, and Catherine pointed it out as well. I use the Chicago Fed financial conditions. One of the things I think is interesting there is a lot of financial conditions indexes, to go into a little bit of detail, use the stock market as part of their, you know, measuring whether financial conditions are tightening or loosening. So I do show the overall index here, but that has a stock market in it, so I don't like to use that to show, well, it's kind of easy for me to say, well, they tightened, so, you know, the stock market went down. Well, thanks, because that's one of the variables that's in it. But the nice thing is, from the Chicago Fed has a couple sub-indices, both a risk index and a credit index. So the risk index has some spreads and yield curves. Credit has, shockingly, credit spreads and credit availability. And either way you look at it, or any way you look at it, you see that big move up in terms of financial conditions tightening, and obviously the stock market on the other moving down really in lockstep. So I think that does show you some of that fear. So I'm bummed that Bill Strauss from the Chicago Fed's not here, but I'll probably catch up with him afterwards and say I'm willing to be paid for an endorsement of the Chicago Feds, you know, kind of like Kim Kardashian. I need to work on some other, you know, I heard she gets $1 million, I guess, to post something on Instagram. I'm willing to work for that kind of money. It's not a problem. So I'll keep going in terms of little Fed policy. I do like to look at the, while I picked on the 10-year versus 3-month spread, I do like to look at the 3-month yield 18 months forward, because I think it does tell you a little bit about the fact that that number peaked in early November of 2018, and it really wasn't long before, as that started to come down, it wasn't long before the decline in the S&P 500 really picked up speed. So I think what it's really telling you is the markets were saying, you know, we really don't need any more hikes, and in fact, you know, we might need to be going the other way, while the Fed actually did raise rates one more time after that. So I think that's where you see the real disagreement in the market and some of the signaling that went on. Let me talk a little bit, this is a kind of messy one, but I grabbed a few different policy uncertainty indexes from Bloomberg. I think, the green one is in particular the trade policy uncertainty. I'd say generally speaking, I could torture this enough to say they're moving in the same direction, with policy uncertainty moving up or, across the board, and it eventually seemingly catching up with the stock market. It's hard to exactly work off of those necessarily to get exact numbers, but I think it does tell the story, I think, fairly well of some of the worries about policy uncertainty showing up. I think when you mix them into what I said earlier on, that kind of toxic stew, it certainly showed up in there. Let's see. In terms of impact on the economy, I took this from the IMF, thank you. So it showed up, this is really their estimate of what the impact of the tariffs implemented in 2018 was on GDP growth. So this is where I would say that it's kind of interesting, where again, at least according to their estimates, it does hurt China more, or did hurt, I guess I have to say, in the past. I'm assuming that if we continue to add on to the tariffs, you'd see similar kind of move in terms of relative moves between the countries. And you can obviously see it showed up in Japan and Europe and wherever else you want to talk about. But I think it's worth noting, clearly the market is aware of that. Again, I kind of mentioned, I think you go into it knowing, market knows it's suboptimal activity and probably hurts things on the margin. It's just a question of how much. I thought this is where you get into some, I guess I'll call them, and Catherine talked about it a little bit, is some, I'll say, secondary impacts. So this is the percent of companies that have or are considering moving production out of China, and also where they're thinking about moving to, which I think in terms of an investment side, and she talked a fair bit about it, I thought that was interesting, so you can kind of see the long-term impact, and I think it is continue to be talked about with companies, that they need to consider their supply chain and where they're getting it from, and you can see the major, I guess, a beneficiary has tended to be other parts, and she hit it right on the head, in other parts of developing Asia. I think I go right to the numbers, and she talked about Vietnam a few times, but this one's a pretty extreme example of year-over-year imports into the US from both China and Vietnam. So that last bar you see is January, Chinese imports down 9%. Vietnamese imports up 35%. So obviously benefited from a little bit of calendar action there, but I think in the end the direction is right. I thought it was interesting, I just came back to Philadelphia, I guess I did go through Houston, but where I live now, but via Omaha. I was at the Berkshire Hathaway meeting. I go there every year, and I always go to get running shoes every year from Brooks, because they own Brooks. This is a long-winded way of getting into the story, which is when I was over there talking to the Brooks people, they mentioned that they're actually moving their production out of China and into Vietnam. So they're actually, by the end of the year, they plan to have all of their production for the running shoes gone from China and in Vietnam. So obviously it's small company, a relatively small company, but certainly they even talked about it, said it was really partly because of the risk to the supply chain. In terms of the tariff, they don't have a lot of pricing power, so they need to be aware of where they're getting things from. So I thought that was an interesting and real world type of thing showing up. Also, close to my own heart now in my new adopted home of Texas is in terms of where Texas exports to, and that yellow line that fell off a cliff is China. So our exports to China fell off the cliff. You might guess what that was, but if you didn't know, we do produce a fair bit of oil and gas. So that's oil and gas exports primarily that fell off, that I'm sure we sent somewhere else, but it's just of note that it did show up there. In terms of the economy, I think I want to talk a little bit about China. So, certainly China is a major part of what the markets watch in terms of the global economy as being the second largest economy. So it's certainly part of the puzzle. I think, I'll focus on what's happened since, I talked about the fact that the PMIs in China topped out in like May of 2018, but we did see a nice sharp rebound in March. I'd also watch this, if you're looking for other data sets to watch, I think it's interesting. Standard Chartered has a small and medium enterprise confidence index in China. I think that one's an interesting one. I also think it's interesting because I think a lot of the Chinese stimulus was targeted towards that segment. And we saw that move up a little bit in advance of even the PMI. So I think, at least in our view, we're seeing some of that better news there. We'll see how they react to this newest round, if it in fact comes through. But at least we had started to see some better action. We talked a bit about, we talked about Vietnam earlier. I think this is the stock performance of China and Vietnam. Vietnamese stocks during the, I guess I'll say during the fourth quarter, didn't decline as much as Chinese stocks, but they also have not rallied back as much. So I think it kind of shows you the exposure to those trade worries. I'll just mention as an aside, that we do have some skin in the game. So our international, or one of our international managers, does actually really like Vietnam. So we're actually have some exposure to Vietnam right now because we not just because of my Brooks story, but we're seeing it as a beneficiary of some of the things that are going on. And since we think it'll work out okay for the global economy, think that on the net that they'll be again the net beneficiaries. So I wanted to go also a little deeper into some of that action within the stock market in terms of some of the trade things. This is a little hard to see, but this is just relative performance cutting a few different ways here. So the first one, U.S. companies with large sales exposure to China. So we saw them, that's underperform to a large extent during the kind of trade war in 2018, and then since here in 2019 have outperformed sharply. So a lot of things, again, similar to what Catherine showed in terms of that underperformance. Really the same story goes for U.S. companies with large importing from China. That's the middle one, so significant underperformance switched to outperformance. And then lastly, if you switch it over and say Chinese companies, so Chinese companies with major exporting to the U.S., that's the major underperformers during the heat of the trade war, and then major outperformers, at least while things seem to be going better, up until over the weekend. So we'll see how that plays out. Since, lastly, I'll just kind of show some work that I did, which was really looking at all of the stock market rallies post 20% declines after World War II. That one that's not obviously completely finished, this is a year after the bottoms of each of them. That's from Christmas Eve to the end of last month, and you can see significantly outperformed either the overall average, or I also broke it into those downturns that were accompanied by a recession and not accompanied by a recession. In terms of the non-recessionary ones, probably the one that stands out that would still be outperforming us now is the 1998 rebound, which obviously we know, led into the real, I'll call it tech bubble. But at least it's interesting to note that it's been a very sharp recovery, and kind of what I've been talking about has been a lot of good expectations, because I think a lot of things I went through that haunted the markets in the fourth quarter have really either reversed completely or at least have partially reversed. So it's not a surprise that when you have a little bit of a surprise from President Trump in terms of maybe putting the market's view that the trade war was maybe closer to over, that you would see at least some sort of a fairly significant response within the market. So we'll see how that plays out. So thank you.
Thank you.
Thank you. Thank you to the organizers and to the attendees for allowing me the opportunity to come and present some of the research that my team within Vanguard's Investment Strategy Group has put together around global trade policy and its implications and interconnectedness with economic fundamentals. So what we have on the left-hand side is some work that we did at the beginning of the year, and similarly to some of my colleagues, we included a baseline case and a pessimistic case The pessimistic case did not seem to have a very high probability heading into 2019. I think that probability may have been elevated just a bit over the last few weeks. So it's something that we are going to continue to revisit, but suffice it to say, what we're looking at on the left-hand side are impacts of the trade war on GDP in 2019 for the US and for China. The blue line is the base case. So what that would represent would be a 3% increase in all the prices of all exports and imports. So it would essentially be 25% tariffs on, I believe it to be $100 billion in Chinese goods, and reciprocal tariffs from China on US goods. So that would be a 3% increase in the price of imports and exports. But we found that just shocking prices alone was not enough to generate much of an impact, particularly in the United States. Right? What we had to do was kind of think second-order effects. Right? How else would this make its way through the economy? And the answer we came up with was through financial market volatility. Right? So what we did was we went into the model, and in addition to shocking import and export prices, we also shocked the BBB spread. So that was our indicator for financial market vol. In the baseline case, it was a 3% increase and a 25 basis point blowout in the BBB spreads. And you can see there, similar to the IMF results, we show the US impact being less than that of China. Even on the baseline, US call it 15 basis points impact on GDP growth in 2019. China call it closer to 30-ish. So that wasn't enough by itself for us to change our GDP forecast this year. The Chinese team did revise theirs down somewhat, such that GDP growth expectation in China is somewhere closer to 6% rather than 6.5%. So these tensions are starting to become a drag for them. And then we looked at the pessimistic case as well, where that was a 10% increase in prices, coinciding with a 100 basis point blowout in the BBB spread. You see that really starts to have some detrimental implications for the economy, US and China as well. That's when we would have to start revisiting our call for US GDP growth. Now, we did revise down our call for US GDP, not based solely on the trade war impact, but the implications that the trade war had on something that some of my colleagues have been discussing, economic policy uncertainty. Right? On the right-hand side, we show the economic policy uncertainty index, which is comprised of different factors trying to tease out not financial market volatility, but economic policy, and I guess it's volatility uncertainty, if you will, around that. And then our own proprietary financial conditions index, which it comprises 12 different underlying variables, including equity markets, yield spreads, absolute level of yields, access to loans, financial conditions, demand for loans, and so on. So what we saw heading into 2019 was spikes in both of those. Right? So we did research around what would happen if those spikes came back down to more normal levels, which prior to this week they had. And even if those shocks had just persisted for the first few months of the year, which they did, that was enough to shave 40 basis points off of our GDP growth forecast. Right? So that did cause us to go in and change our expectations for GDP growth in the US from around 2.5% to much closer to 2% for 2019. So if it's not direct implications of a trade war, it's those secondary effects that we believe have the potential to pass through and really start affecting economic fundamentals. Bill mentioned some of this before, looking at economic policy uncertainty, or rather trade policy uncertainty specifically, and overall economic market volatility. You can see they track reasonably well. The blue is equity market volatility, the tan shows trade policy uncertainty. They don't always move together, but they have recently, towards the end of 2018 to early 2019, which is one of the reasons why it's become more alarming in the current environment. So you throw all this uncertainty, trade policy, broader economic uncertainty, financial market volatility, on top of the Fed trying to operate in a continued environment with what can be deemed extraordinary measures that continue to normalize, it makes for some very difficult investing decisions. So what we show here is the Fed and their expectations for the long-run neutral rate, the Fed funds rate, so the long-run equilibrium clearing rate for the Fed funds rate, and how that has come down over time, coinciding with a fall based on survey-implied terminal Fed funds rate coming from the Philadelphia Federal Reserve. You can see that they've come down from what was more normal neutral Fed funds rate, somewhere around 4 to 5% in years and decades past, somewhere closer to 2.5%. Not too far off from where we are right now. And as President Harker mentioned, doesn't give them a whole lot of room to operate in the event of a downturn. Now the impact there, it doesn't stop with just the federal funds rate, right? It also goes out to other tenders along the yield curve, namely out to the 10-year yield, right? We've talked about some of the factors depressing the 10-year yield. Apostolos did some of the heavy lifting for me this morning, showing the research he did around just how much global trade and the dollar as a reserve currency in which trade is executed, how much downward pressure that can put on the 10-year yield, right? So that again makes for a very difficult investment environment, right? If you have the 10-year yield being depressed by factors such as that, and also a depressed Fed funds rate, doesn't leave for a very high short end of the yield curve and a pretty narrow slope. This is how a lot of my colleagues on the rates team in the fixed income group make a lot of their money, so I haven't been invited to as many happy hours in recent years. I don't have too many optimistic things to say for them. But that's not to say that global trade, the implications have all been bad, right? There have certainly been some very, very positive developments as a result of global trade, and we don't know that these necessarily get as much due as they should. Maybe they did in the past, but I think a lack of acknowledgement of some of the challenges coincides with some of the feelings that we're seeing today, some of the populism where people have really turned against the idea of global trade and think that there can be resolutions to some of the issues that the economy faces by implementing programs such as tariffs. So on the left-hand side, what we're looking at is a 1% increase in trade openness, what that means for business capital investment, what that means for human capital investment, what that means for total factor productivity and GDP per capita. It puts upward pressure on all four of those factors, right? We hear stories about GDP per capita increasing, means we're wealthier. Well, it's a tough environment to talk to people. I came from Bethlehem, Pennsylvania, where 1996, I moved there, and Bethlehem Steel started shutting down, and they've been closed ever since. It's tough to talk about some of the people that have been without a job for 20 plus years about why they should be happy about GDP per capita coming up, even though they haven't been working for the last 2 decades. So again, that's not to say that global trade hasn't had very positive implications for the global economy and even for some industries and sectors within the US economy. But I think a lack of acknowledgement around the implications that it could have on employment and other factors, I think that goes hand in hand with the increase in popular sentiment focused on trade these days. And that's not to say it should all be focused on trade. Right? It seems to us that more so than trade itself, it's been technological development that has really been at the core of driving down employment in areas such as apparel manufacturing, overall manufacturing here in the United States. So we don't know that there's as much focus being placed on technology today and more so on trade. Our hope is that over time there's greater acknowledgement that it is not trade alone that has been depressing employment in certain sectors. And you can see that hasn't just been over the last 10 years. This has been occurring for the last 50. Right? What we're showing in the blue line there are jobs where the computer is a substitute. Right? These would be routine cognitive, so routine thinking jobs, and non-cognitive jobs. They're jobs where repetition is used in creating output. Those are able to be automated away. Right? That's what we've been seeing happen for the better part of the last 70 years now. As you see an increase in employment, the share of the labor market, that is the y-axis, for jobs where computer is a complement, so that's non-routine cognitive, so it's jobs where you have to think through things, analysis, that type of thing, where computers can be used as a complement but not a replacement, or even jobs that the computer's not utilized, right? So non-routine, non-cognitive, janitorial work, if you will, service industry work, where you can't, at least based on today's technologies, replace house cleaners with robots, but we'll have to wait and see. So how did we get to this point with China, with all the tensions, right? In part, this was due to mismessaging, in our view, not only around the impact of technology, but also miscommunication regarding supply chains. Some of my fellow presenters talked about this a bit earlier, where it's not China itself and their impact on the U.S. current account balance, some of the messaging gets lost in there because of really the math behind it. What you have are these traditional exporting economies such as Germany, Japan, EM commodity market exporters who are shipping goods, technologies to assembly hubs in places like China and Mexico, and then that makes its way to consumer markets here in the U.S. Right? On the right-hand side, you can see that the iPhone 4 production process, iPhone cost, we did this a year and a half ago, I think we might have estimated low on the iPhone cost there, but iPhone production cost was around $180. Only 7 of that was added by China. Right? It was their assembling all the technologies and all of the commodities, all the imports or inputs into the iPhone, and then shipping that back to the U.S., which meant that their trade balance with the U.S. is somewhat skewed. Right? So if you look on the bottom here, what we're showing for those various countries is the proportion of the U.S. overall trade deficit accounted for by Mexico, Canada, China, and all others based on traditional measures of trade balance, and then also by adjusting for factors such as the production processes up there. And when you do that work, you see that the China trade balance gets cut almost in half, right? Mexico is a third of what it is under the traditional accounting standards. Canada actually ended up running a surplus when we account for things like manufacturing costs. So again, it's not necessarily deliberate mismessaging, but it's something that we think is important to be added to the conversation that just isn't occurring in today's environment. Some positives for global trade, right? I mentioned before, we do need to acknowledge these, right? This, unfortunately, is lost in the messaging as well. Just a couple of factors we put together based on some IMF research. Without the sharing of knowledge, worker productivity and wages, which are elevated by sharing of information, sharing of technologies, which is facilitated by global trade, wages would be $3.79 lower per day on average. That would mean that the more than 1 billion people who have escaped extreme poverty since 1990 would instead still be making less than $2 a day. Right? Technology, global trade, the sharing of ideas, that in and of itself has been responsible for much of the rising of the population, the global population out of poverty. The benefit of foreign knowledge, so R&D stocks, so investment in research at in other countries on domestic innovation is nearly twice what it was even in 2000. So it's very important that we all continue to share ideas, to trade technologies, to continue to innovate. Firms such as that we talked about with the iPhone that utilize global value chains experience employment growth almost 2 times the rate of firms that do not participate in global value chains. I won't go through all of these, but one other important piece of information, use of information communication technologies, so greater leveraging of video conferencing, what have you, and continued development there, could increase global diffusion of ideas by up to 44%. 44%. So that would mean that we're sharing more information, sharing more ideas, whether it's through trade, whether it's through meetings, right, to help generate the flow of new ideas and new innovation. Absent global trade and increasing global trade tensions have dampened this effect. And then finally, I'll come back to a point that Stephen asked earlier, asked the macroeconomists what they felt about the implications for factors like fiscal policy, which again are not part of the conversation today about what is driving these current account balances. Fiscal policy, in our view, very much is one of the leading factors of wider trade balance deficits. Right? So if we're not taking measures and we're focused more on things like tariffs and not addressing the bigger, more complex issues such as fiscal policy, the evolution of technology, I don't know that you're going to see as much progress made on the trade deficit front if that's the intent of all the rhetoric. So thank you.
Thank you. Thank you very much. We have a few minutes for a few questions. And please address the questions directly to members of the panel or one member of the panel. And in case where we cannot cover all the questions, I'm sure they will be available during the break for individual discussions.
Hi, thank you. I'm Jeff Ferry with the Coalition for a Prosperous America, and we're doing an analysis of the effect of a 25% permanent tariff on China, and we found some of the same results that Catherine shows, including that production would move to Vietnam as the #1 country and other Southeast countries, Asian countries after that. And what we find is that because costs in Vietnam are roughly 20 to 40% lower than costs in China, the lower production costs outweigh the costs of the transition, and a certain small percentage of production moves back to the US, the net result is an increase in GDP in the US, not a decrease. And I would say in light of that the financial markets today are behaving rather like a toddler. They're screaming and crying because they're uncomfortable with change, but once they get taken out of mommy's arms in Beijing and put into daddy's arms in Hanoi, so to speak, they'll get used to it, and we could actually see a growth in the economy, and I'd love to hear your reactions to that. I recognize it's an unusual, unconventional view.
I'm not sure exactly whose arms might be better to be in. I thought what you were going to say is that the reason why the financial markets are responding, or had been responding positively to the likelihood that there would be a US-China trade deal that would narrow the bilateral deficit and therefore move production to Vietnam, that the financial markets were cheering that. Now they're not doing that today, but they were doing that up until today, and I was arguing that in fact they were overestimating the benefits of a US-China trade deal. And I think we're seeing some consequences of that today. So I get the channel that you are arguing is the benefit that would translate into a benefit for the United States is the much lower cost of production in Vietnam. As I understand the exercise that you were running was that because everybody moves to Vietnam, where it's 50% cheaper, that translates into a gain for the United States through the channel of a lower cost of production, and the assumption that US buyers will get the benefit of that lower cost of production, and that is the way in which the US gains. Now you're kind of assuming something like perfect competition and marginal cost pricing, and that US firms are not going to use this lower cost of production as an avenue to increase their profits. In today's environment, that assumption of perfect competition and pass-through of lower costs to lower pricing of products, I think, is a potential question mark. And the second reason why I'm a little bit concerned about the channel that you're mentioning as being the dominant channel is that the share of imported products in the consumption basket is shrinking as the share of domestically produced services, food away from home, entertainment, healthcare, is increasing. So I would worry about the aggregate analysis first, because it overemphasizes the role of imported products, and number two, because it probably assumes perfect competition and pass-through of those lower costs of production to the United States.
Thank you for this analysis. Anybody who wants to add something, or should we go to another question? Yes.
Can I just comment on that for 1 second? You have to be careful. You have to be careful what the metric is that you use to decide whether you're better off or not. I can make GDP go up, but I can be worse off in real income terms. My welfare could go down. So just because I get GDP to go up doesn't mean something's desirable.
Well, our model includes real wages, and they go up. as well.
But that's not consumption. We should measure real consumption to determine whether something better.
Consumption and investment go up with real wages as well.
Well, let's take this debate aside and let's move to the next question, given we have limitations in terms of our time for this session. Thank you.
There's a fascinating book written by Jardine Matheson, executive who retired after 30 years of doing business in China. The book's called Everything I Ever Learned About Doing Business in China. And you open up the book and all the pages are blank. True story. Having dealt with the chemical industry that does a lot of business overseas internationally, there's an intrinsic cost of dealing with countries like China and Korea, which are dealing with people who are bandits, okay? Why would you go into an environment like that with your intellectual property to save a few bucks? It doesn't make any sense. So we sit here in our nice, comfortable room and look at all the charts and share all the numbers. But the reality is these people are there to steal you blind, okay? And it's been proven time and time and time again. So how is China going to continue to survive when you have a country like Vietnam, who is frankly pretty good to do business with, or India is pretty good to do business with, okay? So people are making decisions based on, it's too much aggravation to deal with these people. It's just not about saving bucks. So give me an economic reason why we should be exposed to that kind of business environment.
This is the question, or what's the question?
Well, I think there are a lot of companies who have entered the Chinese market not just as a production platform, which is one reason to be there is to produce there cheaply and export it back to the U.S., but other companies entered China with the expectation that they would end up being able to serve the Chinese marketplace. So the standard reason for locating in a very large, developing economy with a growing middle class is that you think of it as a strategy to develop your production for the market there. I think what has been the revelation over particularly dramatic over the last couple of years, although it's been kind of there in the background for a while, is that U.S. firms developed marketplaces and then were not able to expand their market share commensurate with what they thought that they were going to be able to do as domestic competition in China was given an unfair lift up through channeled credit and indeed IP theft as well. So that's been I think a lot of companies went in thinking, I don't need to get a very big chunk of this market, but it's a really big market, so I'll get some of the market. And over the years, a little bit of that attitude has been eroded, and that as a result, that's they sort of thought that the rules of the game were I'll give up a little bit to my competitors, but not the entire market. And that's been the change in the business community's attitude towards China, perhaps over the last 5 to 7 years.
Thank you. We have President Hart.
So the topic du jour is, of course, China. I'm just curious, given particularly the flow that would go to Mexico in the case of a Chinese trade deal falling apart. We haven't talked about the risks associated with NAFTA 2.0 and the potential that falls apart and then what we fall back on as a result. I'm just curious in your comments.
All right. Well, we could have gone over U.S. China. We could have focused in my remarks on consequences for Europe of a lack of a trade deal there as well, and U.S. Japan. USMCA obviously is on the rocks, and it's very clear it's on the rocks. So most, if if USMCA, if the fallback position is NAFTA, not a problem, right? We don't have a problem. Because USMCA really didn't make such of a big difference. There wasn't really a big deal. But if the fallback position is 25% tariffs on U.S. On products coming out of Mexico as part of the value chain for the U.S. auto industry, that's not a good picture for exactly the sector that is of particular interest for the administration. So, you know, the fallback position is a really important question mark. My view, having brought this up last time we were in Washington with U.S. Chamber of Commerce, International Chamber of Commerce, the business community would be pretty actively involved with whether or not it was even legal to have a fallback that was not NAFTA. Sort of tearing up a treaty is something that the administration cannot do unilaterally. So it would have to be Congress to tear up NAFTA. Even that really is not clear. They can unilaterally tear up a treaty. We put the probability of the fallback position to a USMCA falling apart. The fallback position, the highest probability of that is just NAFTA, and a very low probability of it being a complete collapse of trade relations between North America.
Thank you, and I think with this we conclude this session.